What's up, Jolene?
Are we live?
Yes, we are.
Totally.
I got her. I got her. Yes. It does count. Nope, nope.
Wow.
I'll take my W. Ladies and
Whatever.
gentlemen. Ladies and gentlemen, who has two thumbs and is awesome? This guy, Mark Monroe. Have we met before? All right, so how are you doing?
I continue to bask in the excellence of my blackness on this fine Tuesday in 2022. How about you?
I am feeling amazing. I'm feeling incredible. It's been quite the week. A lot has been transpiring, but I'm excited. I'm excited for today's.
Only Tuesday, Mark.
I know, but it's like I don't know. For some reason, by the time when I get to like Tuesday, Wednesday, I feel like I lived out an entire week.
Okay.
So by the time when I make it to Friday, I feel like that's just like 2 weeks in time for me.
Okay.
I move like that. I
Um,
just move different.
okay.
All right. What's up, everybody? I am Mark Monroe, accompanied by my wonderful co host, co producer, and co creator in all things galactic, coming through with the fresh red spectacles, so to speak. Give it up to the wonderful.
Jillian GC in the place to be. I'm going to be more calm today because I think that's what's needed for today's episode.
Hmm.
Like,
You know, on
wait,
that,
what does it
on that note, I'm about to heat up this room then, real quick. Because
Vic, bring it up.
I'm gonna bring up the VIX. I'm gonna bring up the VIX in the room. By the time when the show is over, everybody's gonna be placed in correction. I promise you, we're gonna place the room in correction before this episode
Okay.
is over. So I'm coming through, and please don't try to send any sanctions this way. But we got a lot to discuss. Like, one of the things that we got to discuss is if you haven't subscribed yet, go ahead and hit that subscribe button down below because we would totally be appreciative. And on top of that, there's a wealth of content that you can just go ahead and indulge for free 99. And on top of that, if you like what we're doing and if you like what we are about and everything else in between, go ahead and hit that like button because we would totally feel so appreciative of you just, spending 3 seconds of your time just to hit that like button. And if you want to be in the know, just like Kwame was, hey, at this thing,
At
hey,
the same
no potato salad controversy this week. We here. You were first, and he definitely had his notification bell on. And honestly, there was no refutable evidence that literally said anything otherwise. So shout outs to you, Kwame, because you are here at number one. And if you want to be like him, make sure you turn on your bell so that way you could be a part of the notification squad, aka the Cool Kids Club. All right, so Jolene, we gotta get some stuff
Let's
out of
talk
the
about what happened in the market, okay?
way. I'm gonna just say the VIX is now currently at 16.
Yeah, the VIX for the room is up there. So we have the Dow negative 482.57 points, Mark. So, now we're at this level of 33,596.61. Then the S&P 500 negative 44.11 points, which leads us to the levels of 4,304.76 points. And then we have the NASDAQ negative 166.55 points, which brings us to a level of 13,381.52 points. Then coming up with the VIX, we already said what the VIX was for this alive. It's currently, would you say 16, Mark?
Yeah, for the live it's 16, but I'm probably guessing for the VIX in the market, what is it at 29.4?
You're close. The VIX was actually at 28.81, so very close. And the 10-year Treasury note, it's coming in hot below 2% at 1.941 percentage points. Heading over to sector performance, as you know, Mark, there are 11 sectors. We track the top three and the bottom three to see what that rotation is looking like. Coming in at number one, it's utilities, followed by real estate, and then health. I will note that all sectors were in the red today. Then for our bottom three, we have materials, energy, and consumer discretionary. Heading over to Pick Performance, as you know, you can find the Come Up Series picks at that Come Up Series on our Instagram page. And if you've been following along, you'll know that Roku is currently in the number one spot at 8.46 percentage points to the upside, followed by DraftKings with a respectable 7.5% to the upside, and Schrodinger, that is ticker symbol SDGR, at 1.86 points. Now we look at our underperformers. We have Restoration Hardware coming in at a negative 6.64 percentage points, followed by C-Web at 8.54 percentage points, and then Home Depot, negative 8.85 percentage points. And one thing I'll note, Mark, is if we look at the range, we have Roku at 8.46 percentage points and Home Depot at negative 8.85 percentage points. So you see that tension on both sides, spectrums, perspective, whatever you like to call it, on the Come Up Series pick list. Back to you, Mark. Just kidding. My God. Okay. Just kidding. We still have Black History to go over, y'all. So
VIX is at 17.
That's 17 now. All right, hold on. Let me pull up this Black History. So we have the San Miguel de Guadalupe, or it's also referred to as the San Miguel de Guadalupe. So there's that too. Slave Rebellion of 1526. This was the first uprising of enslaved Africans on the North American continent. Don't let people tell you that there were no uprisings, because there were plenty of them. Many of them were not documented intentionally. So we have that the San Miguel de Guadalupe is a former Spanish colony founded in 1526 by Lucas Vasquez de Ayllon. And I'm not even sure how you pronounce that, but it's Ayllon. Ayllon? That might be it. It was the third settlement in North America, north of Mexico. In the early 1500s, Spaniards were conducting expeditions to the area now known as South Carolina and Georgia to kidnap Native Americans as slaves. In 1521, a wealthy planter, lawyer, and magistrate, Lucas Vasquez de Ayllon, I'm going to look that up, how you pronounce that, dispatched an expedition led by Francisco Gordillo to the Bahamas to capture natives, and Gordillo returned with 70 Indians. Ayllon took a recently baptized Indian with him to Spain to speak with the court chronicler about his homeland and people, as well as tales of valuable gems found in the region. After meeting with the king, Ayllon received a royal patent giving him permission from King Charles V and the Royal and Supreme Council of Indies to establish a settlement on the eastern seaboard in 1523. The settlers quickly suffered from dysentery, hunger, cold, and Indian attack. On October 18th, Ayllon died, and leadership of the settlement was assumed by Captain Francisco Gomez, who wanted to stay at the settlement and wait for fresh supplies to arrive. Another faction, led by Hines Doncel and his lieutenant Pedro de Bazan, wanted to leave the settlement and return home. Donzel and a group of supporters seized and arrested Gomez and others supporting him and locked them in Donzel's home. When Doncel and Bazan set out to ambush other opponents, the enslaved Africans set fire to his home and freed Gomez and the other captives. The enslaved Africans escaped to live with the local Native Americans. This incident is regarded as the first slave rebellion in mainland North America. By July 1527, only 150 of the original settlers had survived and returned home to Hispaniola. Let me say that again. By July 1527, only 150 of the original settlers had survived and returned home to Hispaniola. So, y'all, just so that you know, there were several uprisings, several, rebellions throughout, and many of them were not recorded intentionally, because if they were, and if news got out, it would just get the people, riled up to fight.
Mm-hmm.
So many of the things that they try to do obviously was intimidate. But even with intimidation tactics, uprisings still happen quite frequently. But again, a lot of that history is lost. So, just keep that in mind, that the struggle was constant. This wasn't taken lightly. It wasn't taken slightly, but, you're coming to a fight, there's guns, and you have rocks, like, or whatever you can get your hands on. And to say that only 150 came back, I mean, there was a lot of bloodshed and a lot of violence. So I just say that all to say, like, just, have a moment, especially during this month and, throughout the year, to recognize and acknowledge and reflect that because of those uprisings and that survival, like, we are here. If that didn't happen, I mean, we might not be here. So
facts.
Shout out to our ancestors.
Whew. So, Jolene.
Yes.
I feel like since this is like the final week of Black History Month, though that we're going to keep Black History lessons churning and churning and churning,
mm-hmm.
I felt like we should end this Tuesday with a School of Investing Day.
Mark, I'm so glad you brought that up, because right now, what we need is to learn more about today's title.
Yes. But I just want to make sure, before we get started, are there any questions?
Okay, so let me tell you about these questions, Mark.
Oh. I'm getting ready to read this VIX. That's what I want.
I mean, the VIX may come up a little bit, but I'm going to keep calm. As a matter of fact, I'm going to take a nourishing sip of water.
Okay.
And woosah, because now I haven't checked the questions since we've been live. I checked them prior to when we had our pre-show meeting, and I was left uninspired by these questions. I'm just going to put it out there. Mark, a lot of the questions just seem to be riddled with fear, like, what should I do? Should I stay in? Should I get out? And are questions that were covered last week, so I'm like, wow, so it just sounds like we have cousins who are experiencing fear, and maybe they're newer cousins. It's really hard to tell. There's so many now, it's hard to tell.
Yeah.
But we have that, and then we have cousins that seem like they're missing some episodes, or I'm not sure what it is, because some of the questions were things that were already covered. Like the title even gives it away that it was already covered. Or, we still have the persistent questions that could easily be answered via a simple Google search. And so when you ask me, are there questions? There were questions, but they're not the kind of questions that are characteristic of the scholars that I know that the cousins are. And so because of that, Mark, I think it's important that, we talk about the things that we wanted to talk about today. And if those types of questions, persist, we'll have to address that when we cross that bridge. Like, if these types of questions keep going, we'll need to change the format, because it's not sustainable.
Yeah. It's like one of the things that I notice a lot of questions that I've been getting is a question on, okay, hey, you taught us, the basics of options trading, but we want to go a little bit further in depth. So one of the things that I'm working on as it pertains to an episode for a breakdown is actually I'm going to be doing a breakdown on calls and puts. So be on the lookout for that. So that way, because it's very easy for folks to look at calls, but then for some reason it could be a little bit difficult as it pertains to when should you actually be selecting puts and everything else, or when should you trade puts. So I'll definitely be doing something like that in the very, very near future. The good thing is now that we're going to be coming up to our final Thursday episode, that means that I can do more pre-recorded content and actually go more in depth and start teaching more. So that's going to be pretty cool. So be on the
Well,
lookout. Put videos and put in call video breakdown should be coming out fairly soon.
right. And I think, and I don't want the cousins to be discouraged, but
At
from
all.
time to time, these things need to be acknowledged and put on the record.
Mm-hmm.
So with that, the questions can keep coming, but they might not make it on air, and that's fine. But one thing, I'm glad that you mentioned that about the fact that we won't be on Thursdays. This is going to give the cousins an opportunity to study more,
Mm-hmm.
to catch up on past episodes, to get concepts right and tight, to do the things that are necessary to prevent having a raggedy portfolio, and then also linking arms with other cousins for your study groups, and creating a ritual out of your research so that these types of questions aren't happening. Like, I mean, I get it, when you're new you need to figure out where to start. I get that. And I think from these types of questions, we can start maybe taking a couple steps back,
Okay.
And creating videos for those topics that were, especially when we have newer cousins coming in, they're trying to figure it out. And sometimes the starter pack, isn't enough. And so between Tuesdays, which is more like a lecture, and supplemental Sundays, thanks to TiVo and AJ and some of the other cousins that have stepped up for that, along with like getting your mindset right with wealth rituals. I think that this new era where we're only coming on Tuesdays will help, because there'll be more time, more capacity, and then other videos. It will free us up to create other videos. So.
Yep.
I'm saying that all to say we hear you, and anytime that these types of questions come in, we know that, okay, let's take a pause, let's regroup, let's reset the room, and really pay attention to like the pulse, and the pulse is telling me it's a good time for us to, take a
Indeed.
pause. And
Indeed.
I'm excited about today's topic.
So you ready?
Yes.
All right, ladies and
Wait,
gentlemen.
I'm not ready.
I ask you politely, get your
Mm-hmm.
pencil, your pens, your paper, your notebooks, because today we're definitely going to go in today. So hopefully y'all ready. So because a lot of folks ask me, hey Mark, how does the stock market move? Or how does the market move? Or what causes the market to move? Well, it'd be nice to give a few cheat codes here and there. So let's get into it, shall we? Cue that transition. Okay, so ladies and gentlemen, welcome to this Come Up Series School of Investing. This is year 2. Don't worry if you are a year 1 student, that is okay, because I'm sure that this content will be around, and you can always pawn the replay for, again, the free 99. So your tuition has already been paid in full, so let's get straight into it. So when we think about like the type of things within market dynamics, right? We think about essentially a vast portion of things, like, for example, the dynamics of stock markets could be a litany of buyers and sellers, algorithmic trading. We could see that economics tends to play a role, but do we ever really go in depth to really like look into it and say, well, what is the real definition of the market dynamic? Well, here you have it. Market dynamics are forces that will impact prices and the behaviors of producers and consumers. In a market, these forces create pricing signals, which result from the fluctuation of supply and demand for a given product or service. Market dynamics can impact any industry or government policy. So if we think about today, if we look at what's been happening in today's market and in economy, so what has caused the market to ultimately move? So what has caused a vast portion of folks in which that are holding on to significant supplies of shares in the stock market? What type of dynamics have changed in 2022 versus 2021 that have literally caused the stock market to literally go into correction? Because normally, what triggers a correction, it's brought on by a specific amount of dynamics. Just like when we see certain stocks or when we see the market go up, there's also dynamics that also tend to lead the market to say, okay, hey, it's a buyer's market. So we're going to get into that a little bit further, because I know I just said a lot, and some of y'all are just like, what? So let's do a small little breakdown, shall we? So there are dynamic market forces other than price and demand and supply. Human emotions also drive decisions, influence the market, and create price signals. So when we think about it, right, you know, a lot of times it's made and brought to you in part by humans. So when we think about, like, for example, those simple things in market dynamics, so let's keep it simple. The basis, so there's a few things in which that lead it on. So when we think about, like, for example, those market dynamics, which I said earlier, which they can be impacted by any industry and government policy, there's a few things to look at. There's, like, what we call demand side economics, which holds that the creation of economic growth is from the high demand of goods and services. There's the basis of supply side economics, and this is the theory that the supply of goods and services is most important in determining economic growth. So these are all forces in which that we're going to get into in a second. So, bear with me for a second. So when we think about those are all considered factors. These are considered market factors. So what are those? There's four of them. There's four major areas in which that we can look at and say that these are significant factors in which that can literally influence the market. So here they are. There's government, there's international transactions, there's speculation and expectation, and supply and demand. Okay, so let's do a quick little breakdown of it. And I'm going to just read it out just in case for folks in whom that are listening to this via audio later on. Government holds much sway over the free markets, as we all know. The fiscal and monetary policies that governments and their central banks put in place have a profound effect on the financial marketplace. By increasing and decreasing interest rates, the U.S. Federal Reserve can effectively slow or attempt to speed up growth within the country. This is called monetary policy. So a lot of folks have been wondering, well, what is monetary policy? And then, of course, when we think about, like, for example, the Federal Reserve, right? The Federal Reserve, their main focus is monetary policy, but it's led by what we call a dual mandate. So a dual mandate is essentially what their goals are. What is it that they are set to achieve? So when we think about that, it literally states that essentially that they are led by two things and two things only as their dual mandate. This is their goal. So their goal is to increase maximum employment and then low and stable inflation. So that's ultimately where you hear them talk about that we want to get to an inflation rate of 2%. So that's ultimately where it comes from, the government side, when we think about the factors that can literally change the dynamics, that can change the dynamics, of a market. So let's look at another one, international transactions. The flow of funds between countries affects the strength of a country's economy and its currency. The more money that is leaving a country, the weaker the country's economy and currency. So I just said a lot, right? So let's look a little bit further into that, because a lot of folks are saying, well, all right, well, what does that mean? Well, countries that predominantly export, whether physical goods or services, are continually bringing money into their country. So this money can then be reinvested and can stimulate the financial markets within those countries. So for example, it's like if we have a lot of money that's going out, or we have a lot of money that's coming in due to, say, for example, what we produce and everything else around the world, then that ultimately allows for more investment. So think about it like this. I'll make it even more simpler. Have you guys ever wondered, like, where does all the money come from when we think about, like, for example, Apple? How is it possible that Apple has over $200 billion in cash? Another thing, how is it that they're able to hold on to so much cash? Because remember, once upon a time, a lot of these companies kept their money outside of the United States. And by them keeping their money outside of the United States, that meant that that money couldn't come back in, one, for taxes, and then two, it couldn't be invested. So, but when they brought that money back into, say, for example, the market, and I don't know if people are having issues hearing me or not. So when we think about it, it's like when that money came back into the market, when Apple brought in that money from the back into the market, because I think that their money was sitting off in Ireland, if I'm correct, because Ireland has very non-stringent laws as it pertains to taxes, and there's tax haven places. We'll get into that in a whole nother situation, or you can probably listen to some of the tax experts out there that speak on it. But all in all, so much to say in such little words is pretty much, when we had an opportunity, the government made it possible to essentially lower the tax rate for a lot of these companies to bring in cash, which ultimately they still got taxed, but then it also allowed for those companies to make reinvestments back into the market. And because of that, then essentially now you started to see, like, okay, hey, they're making either investments into acquisitions and mergers or even doing simple share buybacks. So, which ultimately still helps the stock that happens to sit on the market. So that's another arena. So then we have this other thing called, and I know that this is going to be a very heavy topic a little bit. Speculation and expectation. Speculation and expectation are integral parts of the financial system. Consumers, investors, and politicians still all hold different views about where they think the economy will go in the future. I mean, we all see it today. Like, you have folks that are saying that the economy is going this way, economy is going that way. You got YouTubers out there saying that, hey, the market is going to crash and everything else. So everybody has their own set of speculation, and that affects how they act today. The expectation of the future action is dependent on current acts and shapes both current and future trends. So I just said a lot there. So let's just do a simple breakdown. There's things what we call sentiment indicators, and they're commonly used to gauge how certain groups are feeling about the current economy. Analysis of these indicators, as well as other forms of fundamental and technical analysis, can create a bias or expectation of future price rates and trend direction. So we see these things all the time, which I'll get to in a second. But essentially, why do these things matter? Because of the fact that there can be, at one point in time, we could see a huge amount of speculation, which could ultimately, instead of giving people weathered expectations, then that gives them very, very high expectations. So, for example, we saw that in 2020, and then we also saw it in bits of 2021. And then, of course, we're seeing that even significantly dial back as it pertains to weathering everybody's expectations of where the market is going and what is ultimately the catalyst to get us there. Now, the speculation comes into play because of the fact that we all carry different views, and those views will ultimately fuel exactly where we believe where the market is ultimately going. So the very other thing that we want to look at, which is supply and demand. Now, supply and demand for products, services, currencies, and other investments creates a push-pull dynamic in prices, right? So you can't have one without the other. So, for example, when demand is high, then essentially supply is low. When supply is low, or when supply is high, then demand is probably low. And it's going to be a consistent push-pull. Sometimes you'll find yourself in balance, but it's always going to be a give or take. Okay, so prices and rates change as supply or demand changes. We got that part. If something is in demand and supply begins to shrink, prices will rise. If supply increases beyond current demand, the prices will fall. I mean, think about it like this to keep it simplistic. If you have a store, and if you're selling, let's say, whatever products that you're selling, and all of a sudden, in the first few weeks, you're seeing that significantly amount of folks are literally buying, and you can't even keep the product on the shelves, because every single time when the product hits the shelves, people are buying. So what will you do? You will raise the price. You will raise the price so that way ultimately you can better improve your profit margins. And in improving your profit margins, that makes you more highly profitable. Now, what happens when you start to see that growth starts to slow down? You're going to have to adjust your prices over periods of time, so that way essentially you can still find other folks that are willing to come into the market. Sooner or later, though, you're going to get to a point where you're going to probably have that the demand will ultimately subside, because in a market, we just keep moving. So if supply is relatively stable, prices can fluctuate higher and lower as demand increases and or decreases. So that's, but and this is the thing that what we look at. None of these things are always set in stone. So it's like the market doesn't just move just off of one specific factor. If you really think about it, it's a mixture of all these factors. So these factors can cause both short and long-term fluctuations in the market. But it is also important to understand how all these elements come together to create what we call trends. So while all of these major factors are categorically different, they are all closely linked to one another. For example, government mandates can affect international transactions, which play a role in speculation, and changes in supply and demand can play a role in each and every single one of these other factors. For example, look at what's happening right in front of us today. What we see that's happening in international transactions, aka, for example, what's happening between Russia and Ukraine. Then, of course, you have other countries that have now stepped in. Now, those are going to cause fluctuations within the monetary side for some of those countries, especially Russia, as well as how they do business, aka supply and demand. Look at natural gas, which, if that's causing an impact, say, for example, within the supply and demand of natural gas, then that also increases or could decrease speculation, as well as, say, for example, change or alter the expectations, which therein turns us back to the Fed, aka the government, as it pertains to how is it that they're going to influence monetary policy. So if you really think about it, they're all connected. So I briefly touched upon something though, because I mentioned something about sentiment, right? So what is sentiment? Because that's like the $1 million question of the fact of how is it that we can look at it. So sentiment indicators gauge market psychology in the form of investor or consumer behavior and beliefs that may influence the market. So each and every single one of you essentially have some form of sentiment. Now, of course, there can be an overall market sentiment or an overall market consensus sentiment. Like, for example, if you notice how if over this period of time, we started seeing that due to what's been happening geopolitically as well as globally, interesting enough, think about it like this. Well, that's caused sentiment to change as it pertains to should the Fed raise rates by 50 basis points or should it just be 25? Because now they have to look at it from different angles. If we raise rates too high, that can also put us into a recession, also given exactly what's transpiring in global economics. So again, it's all those things in which that I had just talked about in the previous slide, in which that they can all be connected, essentially can affect the sentiment, which is aka the psychology part. So let's go a little bit further, shall we? So when a sentiment indicator is moving in the same direction as what is analyzing, that typically helps confirm the trend. So when we think about it, extreme readings on a sentiment indicator may cause some traders to take a contrarian view. For example, buy when there is fear, sell when there is greed. Now, you guys have probably seen this indicator before. If you go to CNN Money and look up fear and greed indicator, you see that all across the board. So when the market gets very fearful, then essentially that's normally a contrarian view for value investors to say, okay, hey, it's time for us to start buying. And then, of course, when everybody's getting greedy, then that's when you start to see that everybody essentially starts to get more bearish. So sentiment indicators are used to analyze trends, assets, and the economy from the perspective of the participants involved, instead of just looking at an asset or data point isolation. So what does all that mean, right? Because you're like, okay, Mark, these are great. So I'll give you an example. If a sentiment indicator such as a put to call ratio, so that's a sentiment indicator, put to call ratio is a sentiment indicator, has a very high reading relative to historical values, that indicates investors are expecting the stock market prices to decline. The contrary aspect indicates that prices will likely rise because there are few people left to keep pushing prices lower. What the indicator doesn't tell us is when that will all happen. That's where essentially the speculation starts to kick in, right? Instead, traders use the data to watch for turning points in price when sentiment levels hit extremes. So, all in all to say, right? Because we're getting to the meat and potatoes, right? Because I think a lot of you are like, well, Mark, this sounds all fine and dandy and everything else. But what are some of those sentiment indicators in which that we can look at? I'll give them to you. Well, here are 4 indicators that, a lot of folks tend to look at. Now, remember, when we think about these things, investors can use sentiment indicators to gain insights into the stock market's mood. Extreme readings given by these indicators can indicate impending reversals. So here are just a few just to break it down for you. Now, of course, we all know about the CBOE volatility index, aka the VIX, right? So typically people call it the fear index. And the reason why they call it the fear index is because it spikes when investors purchase a significant amount of put options to protect their portfolios. So for example, if you saw that the VIX was at 30, then that lets you know that the put to call ratio, that lets you know that there's a heavy amount of folks that are buying puts versus the folks in whom which that are buying calls. Now, is this over the long term? Probably not. The VIX typically operates in a short-term fundamental way. So essentially, it's giving you a short-term read of what's taking place now on aggregate of all the put options versus all the call options that are there. Now, when you see that the call options start to supersede the put side, then that's when you start to notice that essentially that the VIX starts to come down. Why? Because essentially that's letting you know that essentially that, again, that everybody is no longer fearful in the market. So investors who buy put options believe the price of the underlying stock will fall. If the VIX spikes, it indicates fear is within the market. Now, another thing that a lot of folks don't really talk about is the New York Stock Exchange high-low indicator. So this is something simple, which is investors can keep track of this indicator to compare stocks making new 52-week highs versus 52-week lows. So spikes in either direction often show extreme bullish or bearish sentiment. And of course, your contrarian investors might use the sentiment indicator to buy quality stocks during periods of severe pessimism, which we started to step into. Now, of course, there's this wonderful thing that we all know and love called the 200-day moving average, which has always been something pretty cool in which that we look at, right? Because this is an indicator that shows us how many stocks are trading above their long-term moving average, so over a 200-day period, and it is expressed as a percentage. For example, if the indicator is rising and shows that over 60% of stocks are trading above their 200-day moving averages, it indicates a broad bullish sentiment. A reading over 80% suggests stocks may be overbought. Right? Now, another thing that you can kind of look at, I didn't put it on here, but a lot of times people look at what we call the RSI, Relative Strength Index, to run in tandem with the 200-day moving average, because of the fact that when you see a stock hit an 80 or 70 to 80 in the RSI, that lets you know that the stock is overbought, and at 30 to, let's say, 20 lets you know that the stock is oversold. Now, there's this other thing that probably a lot of folks don't really talk about called odd lot trading statistics. Now, this indicator measures the number of shares being bought and sold in odd lots, which is less than 100 shares for most stocks. But there's a small little theory behind the sentiment indicator, which is that retail investors who typically have the least amount of money are likely to buy and sell odd lots. So like 13 shares here, 15, 12, whatever. So buy when the sentiment, though, is so here's where it gets really interesting. So remember what we say about retail investors buying at odd lots. So if we think about it, buy when bullish sentiment has peaked and then sell when bearish sentiment reaches its climax. Therefore, when odd lot trading increases during market extremes, savvy investors may take a position in the opposite direction. So for example, when you see that the bullish sentiment when they see that, for example, the bullish sentiment has peaked, then ultimately somebody's going to go in the opposite way and ultimately be a seller. Or for example, when they start seeing that there's an overwhelming amount of bullish sentiment, then essentially what you're going to see is selling, and vice versa. So these things, when we look at sentiment indicators, there's sentiment indicators, and then of course there's technical indicators, which we can get into a whole nother situation. But just remember this: these also have limitations, because sentiment indicators are not timing signals. An extreme reading on the commitment of, like, say for example, any of these, means that the price, like for example, a commitment of traders report, doesn't mean that the price of an asset will immediately reverse. Extreme readings can remain in a place for a long time, or the price may stay where it is while traders unwind their positions and the extreme reading disappears without a significant price reversal. So again, it's never something that's going to be an exact science, but it's something in which that it gives you an idea, again, where the psychology is. So with that being said, that right there is how the market moves. And that's
Okay,
that's on Mary Had a Little Lamb.
So we have this is definitely, upon the replay. Especially when the market is doing what it's doing and we just need to like calm down. I mean, I personally have been calm because I don't know, I'm getting used to this volatility.
Mm-hmm.
But getting back to the market dynamics.
Mm-hmm.
So you mentioned the four.
Mm-hmm.
Government, international transactions, speculation, expectation, and then the market demand and supply. Is that what it was? Or supply and demand?
Mm-hmm.
With those four, when what's the best way to stay on top of that or keep track of that? Like, is it a weekly basis, a monthly basis? Like, what's the cadence for that?
I would say definitely a weekly basis. There's some wonderful tools out there that give you some good information. Like for example, the Day Ahead by Refinitiv. They give you some pretty good insights there as it pertains to where the market is and everything else. That's something that you can literally just go to Refinitiv's website and ultimately get the PDF, and it's normally supplied every day. There's places in which, if you can, look at economic calendars, because that tells you exactly where we are. Excuse me. When it comes to, say, for example, looking at the other parts, that's on the government and economic supply and demand side. International transactions, there's also, you learn stuff about that as well. Like, for example, when you look at foreign exchange, when you look at, say, for example, treasury bonds, if you notice, they don't really talk about the 35, 8, 7, 2-year yields for other countries. They always talk about their 10-year, and those are things in which that you can use. You can also stay abreast to what's also happening around the world, just by reading world economic news. Another thing that you can use when you think about these things, when you start having all this data and understanding exactly where we are. So like, for example, chip supply shortages, when we think about wage inflation, when we think about unemployment, when we think about, like, for example, revenue growth, those things kind of feed into the narrative of speculation and expectations. Like, for example, when we hear a company that gives us guidance during its earnings, it really sets the stage for us when we talk about, really giving us expectations and moving forward. So guidance literally turns into expectations. Notice when you normally see a company that gives its guidance, right? You normally, at that point in time, you'll see that essentially the Wall Street analysts will go back to the drawing board, reshape, retool, and then literally come forth with their expectations that now this company has to beat on a quarterly basis. And if it beats, then ultimately you see a positive result. Or if it didn't, then essentially you typically see a negative result. See, again, it's all built accordingly, and they all go hand in hand. If you have all that information, then it's now just a matter of just connecting the dots and seeing exactly how they all, connect with each other and ultimately correspond.
Did you I may have missed it because I was actually writing something down what you said. For supply and demand, was that under where do we go for supply and demand?
Oh, I mean, when we go to supply and demand, that's us looking at, like, for example, things on a broader scale. You know, when you look at broader scale, you get an overall consensus view. If you're gonna, like, for example, I mentioned chip supply shortage. If I'm looking at chip supply shortage, then I'm
Mm-hmm.
gonna look at not just one company, because that only tells me one part of the story. I'm going to look at, okay, hey, who are the folks that design the chips? Who are the folks that manufacture them? Who are the folks that, like, say, for example, are innovating and creating new, say, for example, innovations within the tech, and seeing exactly where the bottlenecks are? That gives me a consensus view as it pertains to where we are in the supply and demand. So when you start looking at things on a sector basis, when you start, like,
Mm-hmm.
the further that you start to zoom out of a company and start to look at the sector, or start to look at, or the subsector, or the sector, or the industry itself, that's when you really start to see supply and demand.
Okay. Perfect, perfect.
Mm-hmm.
Okay, so then we went over the sentiment indicators,
Mm-hmm.
and this one seems more technical, so it seems like it's easier to track, like because it's already been pulled together, whether it's the VIX, RSI, or the other thing you mentioned, what was it,
So the RSI would be the technical. The VIX
mm,
is a sentiment indicator. The 200-day
mm,
moving average is a sentiment indicator. When we look at the high low, that's a sentiment indicator. And then when we look at odd lots, those are sentiment indicators. Technical analysis would be like Fibonacci, stochastic. And so essentially you take the sentiment and then you cross reference that to technical analysis for that to give you a bit, it gives you a better picture, a much more clearer picture. Sentiment just gives you an idea of where we are in the minds psychologically as as an overall consensus. But technical analysis kind of gives you an idea as it pertains to price action and also price levels, and where is it that we
mm,
could go over periods of time. You put those two together, still speculative and still with some sort of expectations, but again, it
mm.
gives you a broader picture that seems a little bit more clear.
All right, so if we're looking at this, stepping back,
Mm-hmm.
so we have the market dynamics and
Mm-hmm.
we have the sentiment indicators, and
Mm-hmm.
you explain like how you would look about those sections,
Mm-hmm.
um, and then we also have the 5 areas that we've been tracking since the beginning of the year,
Yep.
which were the monetary policy,
Mm-hmm.
uh, sentiment. So we went over sentiment now.
Yep.
Economics data. We've been talking econ this all since last year.
Yep.
Um, Earnings. You mentioned earnings already.
Yep.
And then looking at like the global landscape, aka geopolitical.
International transactions.
So this is just for my the people whose brains work like mine. So if you're making your notes for all this, you would start with those 5 areas that we just talked about: um, the monetary policy, sentiment, economics data, earnings, and global landscape slash geopolitical activities. We talked about sentiment, so sentiment indicators will go under sentiment. So you can create a whole outline this from all these videos. You can make an outline. So
Yep.
if you just want to keep like a if this was like a weekly, we'll just call it, like if this was a weekly ritual, something that you're keeping up with weekly,
Mm-hmm.
then you look at these 5 areas. I would pick the research resources for that information,
Mm-hmm.
and under those 5 areas, for market dynamics, though, I would put that. Let me see. Market dynamics may be its own section, or you may want to kind of break it
Market
apart.
dynamics is the overall arching thing that literally is the overall picture when we look at all five of those pieces. So
Okay.
all five of those pieces fit
Mm-hmm.
within the narrative of market dynamics and what makes the
Okay.
market move.
So market dynamics would be the headline.
Yes.
Then 5 areas.
Yep.
And then when we talk about, sentiment and all that, that falls under sentiment, which is something that we're tracking.
Yep.
So I'm just reiterating it for those who have the brain, like how my brain works. Like in my mind, it's outline form. It has to be, so I can recall it faster. If I can see it in my mind, I can see the outline. Okay, so we have all that. So
Yep.
now that's like the stuff where you are, keeping track of like what's happening in the market, right? And from there, that helps you to be informed. And then you can start building upon your skills as a trader,
Yeah.
right?
Facts.
Okay. So then that's a whole nother video. There's plenty of videos on that. But I think what we should do next is then consider those pieces that fall under the skills that you need as a trader slash investor.
And the cool part about it is that this is like a lot of the overarching lecture, but then the
Mhm.
beautiful thing about having like a supplemental Sundays is that they bring it in and they really go even further in depth. Like my
Mhm.
goal is to show you that essentially that one, that there's nothing new under the sun. Two, that essentially that each and every single one of you can literally become phenomenal at this,
Mhm.
and not be intimidated. And then finally, it's more so in the sense so that way you can see that exactly how really interconnected really is the market. The market just doesn't move off of just one little piece. But when you start to look at the pieces that are there, which are really built within those four key parameters, you really start
Mhm.
to see exactly how they're all connected.
Yeah. And I think that getting that overall picture is helpful when you're starting out. I mean, I wouldn't change the way that I came into all this because it worked for my learning style. And I also recognize there are different, learning styles out there. And there's other complications, we'll just call them, when it comes to this topic of money and wealth. There's like a whole emotional side, based on your relationship to money and, being a good steward and, any pressure you might feel to, make it. So there's a lot that is packed in. So I think that as we, especially with this year, we're in economic recovery.
Mm-hmm.
Um, as we're going through all these different phases of the market, like the business cycles and all that, um, I think the cousins will, uh, especially like the newer ones, will be able to get in where they fit in,
Mm-hmm.
um,
Yeah, I
with
mean,
that.
yeah, I would just say to people, take your time. You know, time ultimately makes pretty much masters of us all, because essentially when we take the time to study, to get better and everything else, and ultimately it's like we get through time, you get better, you get more
Yeah.
sharper, you start to see things, things start to become a little bit more clearer. So I mean, it happens. You don't have to know everything that there is today. Like myself, even in all the years in which I traded, I don't bat 1,000. I'm not batting perfectly, but it's not
Mhm.
more so about me batting perfectly. It's about me batting
In the
efficiently,
game.
punching with a
Mhm.
purpose, and ultimately steadily having strong growth at the end of the year. That's the focus.
Mhm.
There are trades in which that I'll take throughout the year based upon sentiment indicators and technical analysis, across the board, in which that they will probably not pan out that year or through this
Mm.
year. But when I look
Mhm.
at it in overall trajectory, is my overall performance, still on the uptrend versus on the downtrend. And that right
Mhm.
there, hands down, I'm with that every day.
Yeah, and honestly, like you've been in the game for almost 20 years.
Yeah.
So you take that, and then someone
Starting to
like
get a little up
me,
there in age, I might say.
Anyway, someone like me who is less than 5 years
Yep.
in this, what I've found that's helpful is when I started out was focusing on the fundamentals. I didn't bother with technical analysis yet because I was more fundamentals and longer term. So even when there's volatility, pullbacks, corrections, it didn't impact me as much because I had longer term and my portfolio was fine even on the down days.
Yep.
And I think that is why I'm calm now, because I still have that foundation as far as longer term. I think it's when you get into the shorter term and you're like looking every single day and wondering, is this going to happen? Is this going to happen? That short term really can mess with your mental and emotional.
Mm-hmm.
So, but that's okay because then you can also learn technical analysis and you can get better at that.
Mm-hmm.
But for me, in the way, my whole thing is set up, longer term fundamentals set the foundation. And now I'm going back and tightening up. I wouldn't say going back. And now I'm, moving forward with technical analysis, but even still, I'm still long term and fundamentals heavy. And I think like the technical analysis is like flashy,
Yeah.
in my opinion, on social media. Like, look at this chart that I
It's the
just
fast
put.
lane. It's the faster
Right.
lane.
Like if you look at this and you see this tomorrow, this is, it's just like, okay, that's cute and all, but like, what's up with these, fundamentals? What's up with these earning reports? What's the trajectory? So, you just figure out what lane you want to be in and learn the skills needed to, operate at the appropriate speed for that lane.
Yeah.
All right, Mark. So we have 2 minutes. In closing, this is on Thursday. That's our last Thursday for
It should be fun.
live.
It should be fun.
Yeah, it's gonna be fun. I'm like, oh dang, I want to wear like a huge, dress like I'm going to like a gala or something.
Should I
I'm
wear
not.
Should I wear a suit or something? Like, treat
I
it like
mean,
it's the
I think
Oscar
we should do
Awards or
something
something.
different. I think we should do something different. I think we should. Just for fun, do something different. It's the party. It's a celebration. We are marking a moment in time in history where the Thursdays are coming to a close and we're about to switch gears and be at another level. So
I mean, we'll see. We may have a few special guests that come and join us. We've had a lot of amazing people from the culture that have partaken on quite a few Thursday episodes. So, I mean, don't get it twisted, y'all. I mean, we do this to prepare something else that's coming down the pipeline. Like I said, we see ourselves as the catalyst for the Come Up series, but we didn't say that we're gonna be on this channel alone. So, stay tuned.
Yeah,
Preparing the way for other folks to come on in.
Mm-hmm. What is that like? Artist development.
We're a record label. It could be free agent signings. I mean, okay. Draft picks. What? No, I mean, pretty much. There's a lot of great minds and there's a lot of great thinkers out there that can provide a lot of detail and a lot of good information. That love to teach and love to share knowledge and things in which that they wish that the world that they would have known when they got started. So honestly, that's the purpose of to bring great thought leaders and great minds into the Come Up Series family. So yeah,
and we are exactly at 6:30 on the dot.
Hey, look at that. Well, I know what that means because pretty soon it's gonna be like, all right, hey Mark, time to go. All right, so all right, y'all. Well, thank you all for watching. We hope that you guys were able to take in some pretty valuable information. We will definitely see y'all for our final Thursday episode in 2 days. But take your time in this process. The more you learn, the more you earn. And just know, it's not about always being perfect. It's about literally learning along the way and getting better every day. Until next time, I'm Mark Monroe.
And I'm Jillian GC, and the place to be.
And this was your come up. We will see y'all later. Thank you for attending School of Investing. Peace, y'all.